You have identified deep value in Asian equities. Where then does that value lie?
Yeah, obviously it's going to be China. I mean, if you look at the discount versus that of the US, we are at the historical kind of wide. In terms of price to book, China is at 1.2 times versus 2.7 times in the case of the US. So obviously it's deep value play. And to some extent, the rest of Asia has been also influenced by the low valuations in China. So we think Asia is really a place where you want to be parked in for deep value play. Now, do you want to add more to it? I think until we see some substantial stimulus, policy stimulus, we would not add on to it. But for the time being, continue to kind of ride on the winners of the past. For example, technology-related counters, AIs at its early innings. So really on the growth side of our portfolio, buying to, some of these counters or sectors.
Interesting. On the other side of the ledger, Fook, India had a very good year last year because of the China Plus One strategy, a big beneficiary there. But as we keep hearing, India is expensive. How do you position?
Yeah, that's true. India has gone up quite a fair bit. So India is kind of a play on the secular trend. I think we all know the positive structural tailwinds in India. But given the valuations, I think, we would have some representation there for the time being, not an overweight position. But, we kind of look at the markets, the entire kind of world as one market. And the way we structure our portfolio is really, go for what we call the barbell approach, income generators. On the income side, really investment grade is where you want to be in, very good risk reward, 5.5%. Why not? It gives a lot of stability, consistent income to the entire portfolio. On the other side of the portfolio, what we like is quality growth. Now, what has happened, in the last 20 months after the massive 525 basis points of rate hike by the Fed, surely there is a shift in terms of relative attractiveness across asset classes, bonds, equities, cash, private assets. Now, the way we kind of look at the markets is, today with, investment grade at 5.5%, and you attach a historical risk premium to that, equity risk premium, you're talking about 4%. Now, you want to buy equities or companies, it has to clear the 10% annual earnings year growth for the next few years. And you kind of drill down across all the sectors, you would probably gravitate towards technology leaders. So really, that's how we want to kind of, construct our portfolios. Quality growth, primarily on the technology side, on the growth side of our barbell strategy.